Back at the start of 2021, Cathie Wood was the most talked about investor. Her funds had given astronomical returns in back-to-back years, and everyone was ready to jump on the train. Today, however, things look different. After a peak in February 2021, ARK has struggled. As the world has opened up again, many of ARK's investments that performed so well during lockdowns have struggled. So, after the recent dip, is now the perfect time to buy ARK? Or, if inflation fears continue growing, is now the right time to sell? In this video, we're going to explore these questions and discuss the coming crash that Cathie believes nobody is paying attention to. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. Let's get straight into our first clip.
I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you between the company and ARK funds, which are more than half of my IRA, and the significant percentage of my total net worth. We're all in, and my conviction couldn't be higher that the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable. And the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms, they're going to cause a lot of problems for the underlying economy, the traditional world order. And I'll explain a little bit more about that in a moment. So what has happened is in the early stages of the coronavirus, when I was doing those videos, we had algorithms and quantitative strategies focused on just a few variables. They were at that time cash burn and cash cushion. And a lot of our stocks did not have big cash cushions and were burning cash, especially in the genomic space. And they were taken down by 75%, many of them, in a month, just in a month, 3 weeks to a month. And of course, that was the wrong answer. The algorithms got it wrong, and that there was a massive head fake, caused a lot of consternation for the quantitative strategies out there, because, of course, genomics was a big part of the solution to a problem we were facing in the coronavirus. And since February, as this rotation into value from growth really accelerated, these same algorithms have had good success with this strategy. They've been focused on inflation fears, interest rates, and valuations. And they have likened what we're going through right now to the tech and telecom bubble and the bust. And so the algorithms as well are basically looking at momentum and saying, once the bubble pops, that's what they're calling this, it doesn't stop. It's 80-90%. We think that is a vestige of the tech and telecom bubble and bust. A lot of strategies started moving towards benchmark sensitivity because of the tech and telecom bubble and bust. And they really stopped focusing on true innovation, transformative innovation, disruptive innovation. So the gleam in the eye, the dream during the tech and telecom bubble, investors were falling all over themselves to get the next deal and to ride it, up hundreds of percent within a few days. And of course, that was not real. I'm going to read you some of the companies that went poof from that time. These were the largest .com busts: Pets.com, Webvan, eToys, GeoCities, TheGlobe.com, Go.com, Flues.com, DrCoop.com, and Cosman.com. Many of these were out of business within a few years because they were being priced on nothing but eyeballs, not just current eyeballs. Dr. Coop, for example, averaged 1.4 million monthly average users, or the equivalent thereof. And it went public in June of '99 and was out of business in December of '01 because the valuations that people chased were simply based on eyeballs that might materialize and never did materialize. We are nowhere near that situation now. The dreams back then, so the internet was quite transformative and led to the cloud and artificial intelligence. We are living in the reality that dream started. And this reality has companies like Teladoc and Zoom, just to give you a sense of the contrast here. You know, Teladoc has about $2 billion in sales. Its revenues have gone up fourfold since the beginning of the coronavirus. And we don't think that its revenues are going to go down. What we're seeing in the market is a focus on year-over-year momentum. And the comparison that we're going to see, and this is the last of the really tough comparisons, Zoom's revenue 1 year ago, fourth quarter, was up 370%. And in this fourth quarter, the quarter they will report soon, we believe, and their guidance is that revenue will be up 19 to 20%. Think about that. On top of 370%, up 19 to 20%. And that's probably the low point of its growth rate. And we're going to accelerate, we believe, or Zoom's revenue growth is going to accelerate from there. I gave you Zoom. Its revenue, is up 6.5-fold since the beginning of the coronavirus. Teladoc, another stock, telehealth, its revenue is up fourfold. And the Teladoc's revenue is $2 billion on average per year, or this last year. Zoom's about $1 billion. So these are real companies. Their gross margins for Teladoc, they're in the 60s, high 60s. For Zoom, in the low 70s. I may be mixing some of these numbers up, but you've got the point. Very high gross margins, solid revenues, growth continuing from very tough comparisons. And we've got two companies here that are being dismissed as stay-at-home stocks that are going to fall back to earth. And we believe they are not stay-at-home stocks. They are stay-connected stocks, stay globally connected, stay competitive, stay globally competitive. Teladoc being the backbone of the healthcare system from an information point of view here in the United States. And Zoom becoming one of the most important companies, we believe, in the enterprise communication space. Communications is a $1.5 trillion market, enterprise communications globally. And we believe that Microsoft and Zoom together are going to benefit from the first, quote unquote, rip and replace cycle since the early days of the internet in the early 90s when Cisco came of age. And we believe that the dismissal of these stocks is quite misplaced and suggests that analysts or investors are not doing their homework and sizing these markets appropriately.
So first off, the crash that nobody is talking about. Cathie and ARK focus their research on 5 platforms of innovation: artificial intelligence, blockchain, energy storage, robotics, and genomics. Why? Well, because they believe each of these 5 sectors are at a point now where they will begin to grow rapidly in the next 5 years, all according to Wright's law. As a result, they will disrupt traditional markets. In fact, Cathie believes there could be severe consequences for up to 40% of the S&P 500 today as these technologies take off and begin to disrupt. For example, energy storage. It's no secret that electric cars are the future. It might not be true today, but I think we can all see the future coming where we only drive fully electric cars. This will cause serious disruption to the oil industry. Also, consider a future where we all have solar panels or another form of green energy at our homes. If we could harness and store that energy sufficiently through advances in battery technology, we could have localized grids where neighbors sell energy between themselves. Again, another serious disruption to energy companies. However, while this all sounds great, let's remember what's going on today. ARK is significantly down from their peak. While I may agree with them on many of their predictions about the future, the simple fact is that the threats that exist today are weighing too heavily on them. Now, what do I mean by the threats? Well, firstly, many people consider ARK's holdings to be stay-at-home stocks. In other words, they perform well during lockdowns, not so much post-lockdown. Cathie argues against this point by saying that she believes, yes, many of these companies have benefited from everything that's happened in the past couple of years. However, we are never fully going back to the way things were before. So take Zoom, for example. Its 2020 Q4 revenue was a crazy 370% higher than the previous year. No real surprise there. However, what is surprising is that its revenue in 2021 Q4 was up a further 19 to 20%. Now, in spite of that though, Zoom's share price has fallen by around 50% in the past 12 months. So, why is that the case? Well, while there are numerous reasons you could point to, the largest factor is because companies are simply being re-rated as fears of inflation grow. So as we've talked about in recent videos, the Fed today are walking on a tightrope. If they raise interest rates quickly, they may be able to stop inflation getting out of hand. However, they would also likely cause a further drop in the market. In particular, this would hurt Cathie Wood and ARK. If the Fed don't raise interest rates enough though, inflation could continue to grow, and in this situation, everyone would suffer. Now, it's quite easy to sit here and say that the Fed will eventually raise interest rates. I think that's quite obvious. That's bad for ARK's investments, and so as a result, ARK will fall further in value. But the problem with this way of thinking is that it doesn't take into account the fact that investors are already factoring in their predictions to the prices of stocks. So let's say the Fed does raise interest rates, as they will do eventually, but they do it slower and less severely than most people are expecting. This would actually be a positive for ARK because it's slower and less severe than, again, the expectations. On the flip side though, if interest rates are raised faster and sharper than expected, ARK would almost certainly continue to suffer. So, what is the answer? Well, back in March 2021, I talked about how Cathie and her team at ARK had simulated various portfolios. One with no investments in innovation at all. One with 10% invested in innovation, another with 15%, and a final one with 20%. And the point is this: even the most famous invested in innovation only simulated investing a maximum of 20% into ARK. A maximum of 20% into ARK. So listen, nobody really knows where ARK is headed next. And trying to predict this is why so many investors commonly lag the market benchmarks. ARK offer something unique that you will not find in many indexes. For me, they are a strong addition to a portfolio for this exact reason, but only as a small part of a diversified portfolio. Remember, even they didn't simulate investing more than 20% of a portfolio into ARK. Now I'm keen to hear your thoughts. Are you holding ARK for the long term? Personally, I have never sold a single share and I have no plans to do so. But I'm also well diversified across other markets too, as I've been sharing this whole time. So let me know your thoughts in the comments below. Thank you for watching and I will see you again very soon.